it's been a very interesting time. I think anyone who said, I think it was a Chinese saying, may you live in an interesting times, probably refer to the time we are living in. Can't get more interesting than this. And I think as if 2016 was interesting with Donald Trump and Brexit and so many other things, and demonetization, of course, back home, I think 2017 is likely to be as equally eventful or interesting, where I think the only certainty going forward is continuity of uncertainty. And I think we'll have to live with this animal called volatility if we are in markets. Talking about the union budget, as a small kid in 1980s, when I used to listen to the budget speech, and in those days it used to be at 5 p.m. in evening, and we only used to buy two things. I mean, in the cosmetics have become cheaper, or the cooking gas has become costlier, nothing beyond that. And the entire attention used to be on the tax proposals, which is the part B of the union budget. This time, talking about the part B, just said that there is an annexure, and the entire attention is on the part A and how much we have moved, where we were and where we are today. So as I said, that if you pick up a newspaper on next day, the big headline would be like, refrigerators and TVs have become costlier, and whatever cosmetics have become cheaper, and the minimum exemption limit, a standard deduction, ATL limit from 3,000 to 5,000. That used to be the entire news, entire analysis of the budget next day. And I think a lot of credit for making the budget so interesting probably goes to Nanir Palkhiwala and for the thousands of people who used to get collected in Gurgaon Stadium every year. And that's where so much of interest got generated, because there is no other country on planet Earth where people even know which is the day the budget got presented in their country. So in US, in the Congressional Budget Office, when they present, none of the US citizens would even be aware about it. But how much we have moved today. I mean, if you are in a cab on the day of the budget and you ask him how was the budget, he will say that the fiscal deficit was 3.2% of GDP. Even if you're looking at a Hindi news channel or a regional channel, even there you will constantly keep seeing that what has been done in terms of fiscal deficit. But because I think historically the budget has also been used as an agenda, not only as a the statement of government's income and expenditure and some tax proposals. Over the years, it has become a State of the Union address where the the finance minister has to use certain words, and these words have to find a place in the budget. Few of them, couple of times. So there has to be a mention of, let's say, Garib, Kisan, Jawan, women, Northeast, Jammu and Kashmir, handloom, exporters, powerloom, fisher, whatever. I mean, these are some minorities. There has to be certain mention of these names. But one of the most important thing, and as I mentioned on a lighter note, that even if you ask a cab driver and say 3.2% fiscal deficit, how much we have moved forward. Why so much of fuss about that number? 3.2, 3.5, how does it really matter? If the economy is in a slowdown, particularly post-demonetization, the private capex is not happening, consumption has slowed down a little bit, the global situation is uncertain, the government should spend some money to spur the economy, to rekindle the animal spirit. Why they are not doing it? The reason is the total household savings in India, which goes into the financial savings, are 7.9% of GDP. If the central government borrows 3.5%, state government borrows another 3.5%, there is very little money left for the private sector. So government starts crowding out the private investment. The another thing, this year, the government of India, central government will pay 5,30,000 crores only against interest payment on the borrowings that have been accumulated over the years. The total amount of debt that the central, and I'm talking about the central government, state government is different. So the total fiscal deficit and the interest expenditure is almost the same number. The total debt to GDP, the total debt that has been accumulated by the central government and the state government as a percentage of GDP is almost 68, 69%, one of the highest in the world when you compare with most of the other emerging markets. And if we keep on borrowing like this 5 lakh crore will become 6, 7 and all. It's going to be unmanageable. If the government spends more money when private capex is not happening, investments are not coming, it will surely lead to more inflation. We have seen that, how that movie plays out in 2013. We have seen that earlier in 2008-9. And I think it's a full credit to the government that despite all the political pressure, I'm sure pressure from inside the government, they did not succumb to the pressure and remain on the path of fiscal consolidation. Now, we also see in the context of what the Reserve Bank of India has done a few days back, where almost everybody was expecting them to cut interest rate, and they did not cut interest rate. You have inflation, the consumer price inflation at 3.4%. You have the policy rates at 6.25%. And he's saying that the core CPI has not come down. We want to bring down the inflationary expectations in India. India is the only country in the world which is pursuing this path, a tighter monetary policy, or let me put it this way, a prudent monetary policy, a prudent fiscal policy. Look at the rest of the world where since 2008, the world has moved to lower interest rate, to zero interest rates, to negative interest rates, forward guidance, quantitative easing, helicopter money, and now Trump is talking about it, which I believe will be followed by everybody, is fiscal loosening, where the government will borrow a lot more money and spend at the same time when the interest rates are at 0%. So India is moving in a completely different direction. And I think it's important because I think the foundation of fiscal prudence, of a very sound monetary policy will go a long way in sustaining a structural long-term growth momentum in India without inflation. So US had this era of 80s, 90s because Paul Volcker killed the inflationary expectations in US when he was the chairman of US Federal Reserve, and Ronald Reagan with his policies ensured that US remained on a path of macroeconomic stability, and US had a long period of what is known as NICE, non-inflationary continued expansion. I think India is moving towards that long-term 10, 20 years, non-inflationary continued expansion because we are really doing hard work compared to taking the easy solutions. I'm sure everybody would have heard a lot about the budget. I'm sure so much of analysis that happens, and of a small document, it's one of the probably most discussed document. So I won't go much into the details. I'll just touch upon 2 or 3 points which may not have got discussed as much. As I compare the world with where the world is moving in terms of fiscal and monetary policy and where India is moving, the another big difference, so particularly after Donald Trump, Brexit and all, the whole world, particularly the Western world, and the rest of the world is yet to retaliate, but it's likely to happen, is moving towards an era of anti-globalization, protectionism, anti-trade, anti-immigration. And you look at India, we dismantled FIPB. We were just discussing about Foreign Investment Promotion Board. We are opening up FDI. This is coming from a party which has been known as a nationalist. Even today you read any global paper, global magazine, Hindu Nationalist Party, BJP, and it cut across party lines. I mean, whether it's the UPA, whether you look at what the left government is doing in Kerala or most of the other governments, and I'm sure if we have another regime in any part, I think it cut crores to 24,000 crores. If there is a drought or let's say rural area wants some support, you say from NREGA 28,000 crores to 38,000 crores. What does it mean? You really don't know whether it's going to impact the rural economy. Some beginning has been made, and I was very happy when I heard about the NREGA 5 lakh ponds to be constructed, or the ponds that to be reconstructed or whatever. I think it's a small beginning. Similarly, if I heard it right during the talk about the education, he talked about learning-based outcome when there was a talk about the University Grant Commission. Or while healthcare, removal of tuberculosis by 2025 and one more disease by 2020. I'm sure this is a very small beginning. We have a long way to go, but I think this is the path that we need to take. Another interesting thing about this budget is, and it's not particularly about this budget, but where we are moving. So India historically has been a very data poor country. So in United States, first Friday of the next month, you get how many jobs got created. Such a large economy, 300 million people, you know how many jobs got created. Of course, that number gets revised a little bit here and there, but you have high frequency data every week about every part of the activity which is happening. In India, you don't know how many people are employed or unemployed or semi-employed. But I think we are leapfrogging. One of the wonderful things that we have, which no other country in the world I can think of where more than 1 billion people have got a biometric card, and with lots of other things that are happening with the penetration of mobile phone. Today, the finance minister could say that the number of people who file their tax return with an income over 5 lakh rupees, out of these many people are the salaried employees, but these many number of people traveled overseas, these many people have bought cars last year. When you're talking about the ponds under the NREGA, geo-tagging, I'm sure at some point in time, if Google Maps has every building of India, I'm sure government will know every single property in India, and that can be tagged. I think India can leapfrog in terms of the whole digital technology can put us in a completely different world. And I think it could be a very, very big thing. And how it can help, for example, the tax to GDP ratio can go up very substantially. The overall tax projections this year are like very small, less than 10%. Excise is some 4 or 5%. Custom duty, I think some 10 or 11%. Service tax, similar. I think the service, custom, excise, they're all like single digit or close to the 11-12%, but the income tax collections are projected to grow, personal income tax projected to grow at 25%, and that confidence comes from improved tax compliance because government knows what everybody has been doing. This is just one aspect, but it can be used in several other ways. One of the biggest challenge with India has been the last mile delivery or the governance. The governance can improve very substantially. In few years' time, I'll be surprised if government makes a single rupee of payment in cash or government accepts a single rupee of cash. And I think that will change India very dramatically. They are already talking about fertilizer subsidy and the food subsidy moving through the Aadhaar, and then you know that where the money actually is moving, and I think it can go a long way in terms of improving the overall governance, in terms of improving the last mile delivery. When you have access to this data, even the private sector can do a lot of things with a data-rich society that we are becoming. One of the criticism has been that government has not done enough for job creation, or there is nothing in the budget which can spur the growth. What I think in next couple of years could be the growth drivers of India, regardless what has been done in this budget. And before that, I'll talk about another thing, which is apart from this data-rich society or so much of analytics investment that the government has done, in last 2 or 3 things, a combination of things that have been done, and just to name a few, the whole JAM Trinity, the Jan Dhan Yojana, Aadhaar, mobility more or less gets counted. But I think what it will do is increase India's tax to GDP ratio very, very substantially. We have a very, very small government today. The government's ability to really make a large impact, whether to build the physical infrastructure, social infrastructure, or the governance is very, very small. The number of people that you have, let's say in some of the municipalities in India compared to, let's say, was there with New York, I think is probably fraction, 1/20th or 1/30th of that. You need to invest a lot more in the government. That can be done when we have a much larger tax revenue base, which I think is likely to happen. And of course, when as I said, the data rich and digital economy, where the governance will become easier. I think all these things, apart from increasing the tax to GDP ratio, will also do something very interesting, which is that the whole finance becomes digitalized. And when finance becomes digitalized, the savings become financialized. A large part of the savings which don't come to the financial markets start going to the financial market. The money that has been moving into the unproductive investments, once they come into the banking channel, over a period of time with the government's move, I think it starts coming to the financial market. And that does something very interesting, which is that historically, our markets have always danced to the tune of global liquidity, global risk appetite, global interest rate, global mood about the risk assets. As something happens in Greece, I mean, if Europe sneezes, I mean, global markets, global investors, I think that can change very dramatically when all the things that I talked about and the impact that it can have. What are those 3 or 4 growth drivers that I think could be quite interesting next few years, which are not talked about as much, and people always kind of look forward to what the government is doing? First, I think if you just put a few things together, what's happening for rural India. Crop insurance is one of the biggest things that has happened for us. I'm sure it'll take some time for it to really penetrate and everybody gets benefit of it. But it can put farmers on a completely different wicket. With the crop insurance, more money in rural roads, more money in rural electricity, more money in irrigation, more GDP of rural India is substantially lower than the per capita GDP of India or the urban India. But I think that gap can reduce over a period of time. If you listen to the Prime Minister these days, he uses the word Garib 3 times in every sentence. And I think the discourse has changed quite a bit in the last couple of quarters. I think same with the state governments, the spending. By the way, we pay so much attention to the central government. More important is all the collective budgets of the state government. They have more money to spend than what the central government has, where we pay very, very little attention. UP's government's budget is 20% of India's budget. It's as large. And it's like UP, if it was an independent country, would have been the 5th largest nation on earth. So with all that, I think rural India can really surprise on upside in the next few years. Global commodity prices have been lower for last couple of years, but they have been inching up. So everything that India exports, whether it's soya, whether it's cotton, whether it's guar gum, whether it's like a couple of things, sugar that India exports, I think those prices have been inching up, and there could be a revival of rural India in the next few years. The second, I think, is affordable housing. It's not because something has been mentioned in this budget, but even otherwise, my view is that everybody in India, I mean, most of the HNI clients of Himanshu and team would have some plot somewhere in India, which is very liquid now. You can't do anything with that plot. Nobody is a buyer. What will you do with that? I think we'll construct affordable houses there within the government's definition. And that's like pretty decent size. You're talking about now 500-600 square feet. At that price point, there is tremendous latent demand in India. And now with the rising incomes, it will become affordable. And with the EMIs going down, now that mortgage rates are below 9%, and with the interest subvention, they will become very, very affordable. I think that affordable housing, and it's not only about the people who construct those houses, but when you do so much of housing, and I'm not talking of 10 million houses, what the government has said will happen, but even if a couple of million happens, which I'm pretty sure about, not only because the government is pushing it, but even private entrepreneurs will find that a very, very lucrative proposition. The income is tax-free, and it will be a good way to convert the black money into the white. Even if you don't make money there, you're converting your idle investment into the realized investment, which is tax-free, will happen. And then you use glass, you use rubber, you use tiles, you use cement, you use steel, you use all kinds of things. It provides employment. The third thing which is very underappreciated in India is a revolution which is happening on the access to credit. And people ask me how much RBI will cut interest rate in this cycle. Of course, they've cut 175 basis points. That doesn't matter. It doesn't matter whether RBI cuts another 50 bips or 1%. The real India story is not about it. The India story is the person who's borrowing money today at 60% will get at 30%. The person borrowing money at 30% will get at 18. People borrowing at 18 will get at 12, and the people borrowing at 12 will get at 18. And it's happening in front of our eyes. The growth of retail credit for most of the private sector banks, the credit as a whole for the banking system is growing in single digits. This is the lowest period in last 40 years. But the retail credit is growing like in 20% plus. If you look at most of the private sector banks, State Bank of India on such a large size, the retail credit last quarter was growing at 20% plus. I'm talking of September. You look at the growth of MFIs, small finance banks, NBFCs, housing finance companies. You will have some of these payment banks and their ability to do the peer-to-peer lending, so on and so forth. And it's a revolution in India. As finance becomes more and more digitalized, I think ability to borrow for everybody, and household balance sheets are so under leveraged in India that ability to borrow is very, very large. So a small business guy, somebody who's running a restaurant, his entire receipts are in cash. Today, he cannot go to a bank or NBFC can borrow money. Once he get a POS machine, it's easier for him to borrow money because the bank has the full control on his cash flows. I mean, if your son or daughter has just passed, let's say, a BDS, which is Bachelor of Dental Surgery, I can assure you, just take maybe one shop here in Gurgaon and just maybe find one of those direct marketing associates of private banks or NBFCs. Just give them two things, maybe your Aadhaar card, PAN card. If you have, if you don't have, it's okay. And the leave and that license agreement. Based on that and that degree, I can assure you by evening he'll come to you and say that 5 banks have sanctioned 20 lakh rupees. Credit is becoming that easier, which is a very, very revolutionary thing. This is the reason access to credit and the credit to GDP went up. After 2008, China shouldn't have grown. Looking at the global economy, and they were so dependent on export. China has been doing reasonably well for last 7 or 8 years. Post the global financial crisis, Western world shouldn't have done so well, but it's just the credit, I think the access to credit, particularly before that, I think post the crisis of 2000, the US shouldn't have grown at the pace they were growing, but they made credit very, very easy. I'm sure it's going to create some problems. Some of the MFIs will go belly up, some of the NBFCs will go belly up, some of the HFCs will default, no doubt about it. That's the nature of the beast. But having said that, I think the sheer availability of credit, the sheer access of credit, and the sharp fall in the cost of credit will do a lot of good for the economy. One more thing. Last couple of years, one of our biggest challenge has been the slowing global growth and the slowing global trade. Global trade has been slowing down. Global growth has been falling. And we also got impacted. So last 2 years, our exports have been falling. Like month after month, you see a decline in exports. Last 3 or 4 months, our exports have started inching up. And of course, the government can take credit for Make in India. But the fact is, the global economy is on an uptrend. And I have a very strong view for last several months that the global economy is coming out of a 7-8 year, not a recession, but a slow growth period, and is on a mend. I mean, if you look at economic data in US, you look at economic data in Europe, you look at economic data in China, you look at economic data in Japan, every part of the world, the global economy is on a mend. And I think the global economy, which has been a headwind for us, can suddenly become a tailwind for us. This is despite all the talks about the protectionism, the border adjustment tax by the Trump and the Brexit and all that. The global economy is doing well. We are so small from a global scheme of things that I think rising exports, which has been one of the pain point for us, can suddenly become a tailwind. The biggest challenge, so if you have 4 cylinders for economic growth, you have private consumption, private investment, government spending, and exports. So 2 or 3 cylinders were not working. Now a private consumption that got impacted by the demonetization, but it's coming back on track. You meet Berger Paints, you meet Asian Paints, you meet Pidilite, you meet Titan, you meet Maruti, everybody tells you that things seem to be coming back on track much sooner than they expected after the demonetization. So private consumption, and I'm particularly very positive on rural economy. The second driver is private capex, which I think will take a lot of time. Why it will take a lot of time? You think from people who are in business here, if you have capacity, so much of excess capacity, you have so much of debt in the private sector's balance sheet, banks are not in a position to lend, there is global uncertainty, and then you have the 8 o'clock Beno Bhaiyo. Still, there is some bit of uncertainty on a lighter note. So in that environment, I think it will take some more time for private sector to get the confidence and invest. So that will remain, I think, one of the engine which will fire maybe at maybe 2018-19, not before that. The third is the government spending, where, as I said, that of course I think last 2 years of this government, I'm sure the focus would again be on the infrastructure spending. Of course, they are within the overall fiscal prudent framework, not excessive spending, but I think it has slowed down a little bit in last few months, but I think it'll come back on track, and state governments are doing a lot on that front. So I think that's likely to increase, and exports, as I said, that have already started inching up. So I think while there are a lot of reasons to be cautious, but there are a lot of reasons to be cheerful as well. Things are moving in the right direction. When you think about the market, so at the beginning of 2016, had I told you, if you had a crystal ball and you were an investor in US or Europe, and had I told you that Donald Trump will become US president, Brexit will happen, UK will move out of Europe, terrorist attack will happen in Germany, and ISIS will keep on doing what they have been doing for last few years in whole of Europe, Chinese currency will go from 6.25 to 6.95, and I can just kind of go on. You would have said just short S&P, just short FTSE UK, and then just keep money in gold or probably keep money in US Treasuries. The fact is, US Treasury yields have moved up 100 basis points. US equity markets are at a new high. UK equity markets are at a new high. Now, conversely, had I told you about India that this year you'll have one of the biggest reform in banking sector, there's a bankruptcy code. We'll have one of the biggest taxation reform, and Mukesh will talk about it, GST. You will have Aadhaar bill, which I think is probably going to be transformational, the way it can change the several things in terms of governance and last mile delivery and so many things. You will have a real estate regulatory bill. You will have the MPC, the Monetary Policy Committee, which again I think is one of the biggest reform that we have seen for a long time. You will have, I can just go on, you will have a very good monsoon after 2 bad monsoon. You will have the 7th Pay Commission, consumption will do well. Government has been spending money on roads and railways and defense and power T&D and waterways and all that. You would have said that just sell your house and buy equities. The fact is that markets were almost flat by the end of the year because there are a lot of other factors that move market. As we go into the 2017, the most important thing, while again I think why I'm giving you these two examples of the world and India, is that while people will keep focusing on the news flow, and these days with the social media and your Facebook and WhatsApp and all the TV channels and all that, I think we remain so glued on the headlines. The headlines are not going to be great. I think 2016 and 2017 is not going to be different than 2016. I think Marine Le Pen is becoming very popular in France. I think she is like, again, maybe a Donald Trump version in France. You will hear about maybe a possibility of Brexit. We'll see a similar movement in Italy. All the extreme right-wing parties are gaining huge popularity in Europe. You'll hear about maybe Euro can break up. If there is 1 year where Euro can break up, probably it's 2017. But by the way, I'll put my personal money in European equities because I think the market will neglect all that headline and the markets may go in a different direction because the underlying economy is doing well. Trump will keep us busy throughout the year. There's always a lot of risk with China, the kind of debt that they have accumulated over the years. That economy was $2 trillion 10 years back. It's $10 trillion today, and the world has hardly grown. The world economy has moved from probably $70 trillion to $76, $77 trillion in the same period where China has moved from 2 to 10. And how they have done, they've just ballooned the debt level. So of course one day it may have some challenges. So you'll have the UP election in few days time, and you will have probably some other state election in few months time. But I think investors should neglect most of these news flows. I think we want to really make money. Just don't focus on most of these news flow. Because of this, if markets are volatile, that gives you an opportunity to probably buy equities in India from a longer term perspective, because historically it's been proven that whenever you buy equities, when you have that kind of news flow, it has been a good investment. What gives me that confidence? The confidence comes from, I give you a historical data. Over the last 35 years or so, when we have the data about the Indian equity markets, there have been only 3 periods where market didn't deliver returns for 3 consecutive years. So in last year in 2016, but for the last week post-Christmas, if market wasn't up, I think it would have been a flat year. 2015 was down. So 2015 and 16, you didn't make money in equity market. The last time that happened was in 2000 and 2001. And 2002 also you didn't make money. So 3 consecutive years, that has only happened once in history. Before that, it happened in 95, 96, the last 2 years of Narasimha Rao, but then you had a decent rally. And before that, it happened was Rajiv Gandhi's 2nd and 3rd year, 86 and 87, and after that, you had a decent rally. So there have been only 2 or 3 periods where if you invested in equity markets and the markets didn't deliver good returns for 2 years, the rest of the period has been good. Over the last 20 years or so, corporate profits in India have grown at a pace of around 14-15% over the last 20 years or so, which is also in line with the nominal GDP growth of India. But in last 5 years, that profit growth has been in single digit. It has been a real drought for corporate earnings. It's been a variety of sure everybody is aware of. I think in next couple of years, 5, 7, 10 years, we should logically, mean reversion should happen. We should go back to the long-term range of profit growth of 13-14% in line with the nominal GDP growth. The valuations today are 17 times or so in terms of markets PE. If valuations remain here, that's the return one should expect in the equity market. If the profit growth is, let's say, 13-14% for next 5 years, where valuations are today, if they are there after 5 years, that's the return one should expect over a 5-year period. My framework of, are you in a bull market or in a bear market? I think you need 4 things to be in a sustainable bull market. When I say sustainable bull market, not that you won't have any correction. I mean, even in a period of 2003 2003 to 2009, let's say 2002 to 2009, when index moved up from 3,000 to 21,000, we had several periods where markets corrected 10%, 20%. In fact, in 2008, market corrected 60% in one calendar year. But between 2002 and 2009, with 3 or 4 large corrections, the money was like 7 times in that period. So that was a bull market. I think we are in a bull market. What gives me that confidence? I think you need 4 things for a bull market to sustain. The number one is a stable macro and political environment. I think we are in a stable macro environment. I think India's macro has never been better than where we are today. Whether you look at the fiscal deficit, you look at the current account, you look at the foreign exchange reserves, you look at the inflation, you look at the interest rate cycle. There are challenges. One can talk about so we have twin deficit and a twin balance sheet problem. Twin deficit has been sorted out. Twin balance sheet, which is stress in the corporate book and stress in the banking book, which is still there, but the process of deleveraging is on. And I told you that private capex is something that one shouldn't expect. The other cylinders are firing. But I think overall, if the government didn't succumb to the pressure in this environment and you're going into the UP, a very, very crucial election, that gives me confidence after 4 budget that I think government will remain on that path. If the RBI did not cut interest rate after so much of the demonetization and the after effect of that, that gives me confidence that they are on a path of sustained macroeconomic stability. So I think we have a stable macroeconomic environment. You need rising corporate profitability, and I told you that last few years have been a drought on corporate earnings, next few years as we mean revert. And some of the reasons that have been dragging down the corporate profits, the fall in global commodity prices. So when oil prices fall, it's good for our macro. We are buying cheaper oil, it's good for fiscal deficit, it's good for current account, it's good for inflation, good for interest rate, but it also impacts the profitability of several companies where the profits are based on commodity prices. So Tata Steel, Hindalco, Vedanta, they posted record losses. Now there will be record profits at these prices. So, and the other reasons like the too bad monsoon in the year before, but I think the rural economy is recovering. Then IT and healthcare, those sectors had their own set of challenges, but maybe at these levels they are looking attractive. So overall, stable macro, rising corporate profitability. Third thing is starting valuation should be reasonable when you are investing. India's economy has grown substantially from January 2008 till now, but market hasn't delivered that return because that time in January 2008, equities were trading at 24 times P. Today we are trading at 16 or 17 times. It's not cheap as it was in 2009, but it's not as richly valued as it was in 2008. I think we are reasonably valued. And now that the interest rates have come down, you can't expect PE to really go down. And the last but not the least, I mean, you may have the best flat with the best clubhouse and everything, the best society, best neighbors, and if you want to sell a flat, somebody from emerging markets to the developed markets. So the investors are putting redemptions in emerging market mutual funds and putting money in US equities because US equities have been going up and developed market equities have been doing well. Will this continue? I don't think so. If my view on global economy is correct, that global economy as a man, global economy is doing well, the larger trade over the next couple of years will be money moving from bond to equity, and not money moving from EM to DM or DM to EM or from US to European equities or European to Australian equities. The larger trade would be money moving from bonds to equities because structurally the monetary policy is going to be tight, fiscal policy is going to be loose, and I think the global growth is coming back already. There are all the signs, and then the larger trade would be money going into equity. When that happens, India will also get its share of flows in next couple of years from the global investors. I keep saying concerns about Europe. Things are changing, and everybody is doing well. But the bigger heartening feature in India is the money that's moving from the domestic investors in the equity market. Today, the money that we get as a mutual fund industry from the systematic investment plan, the SIPs, is almost 4,000 crores. More than 1 crore people are putting money in SIPs every month. That's 4,000 crores. You have NPS, which is investing every month. You have EPFO, which has just started investing a year back. You have the ULIPs, insurance companies. All this put together is like close to 1 lakh crore or something. In last 1.5 years, domestic investors have invested more money than foreign investors. And I think that trend has just begun in India. This is the tip of the iceberg. In last like 3 years or so, mutual funds have got 2.5 lakh crores of equity flows, but I think this is just the tip of the iceberg. We have a long way to go. Indian investors are so under invested in equities. I think that proportion will keep increasing, and this will get accentuated after the demonetization because the money in bank account is earning 6-7% and you're paying 30% tax on that. So that's like 4-5% return. The return expectations from equity as an asset class will fall very sharply now. I mean, I go around and people ask me, 10-12% aa jayega na? Well, can I make 10-12% because it's like tax-free after a year? You cannot make 6-7% tax-free so easily now going forward. There are no tax-free bonds now that the government is issuing. Making 6-7% on fixed income, making 10-12% on equities after tax will look like a very good return, and that will move a lot of household savings. Nobody is going to invest in real estate, and I'm sure not in gold. That will just ensure that a lot of money from the domestic investors will keep coming to the market. Now, lastly, before I close, I'll just say that there might be some short-term challenges. I talked about private capex will take time. There are lots of execution challenges in India, but I have a strong feel that over the next couple of decades, India will produce an economic miracle, which is unparalleled in human history. Why I say that at $1,500 per capita, the kind of institutions that we have created, it took 100 years for United States to move to a universal franchise. Women didn't have a vote. I mean, one person, one vote. I think it took more than a century for UK to reach there. Nobody had a central bank which is as independent as probably we have, despite maybe whatever you have heard during the demonetization time. The kind of institutions that we have created, whether it's election commission, whether it's, I mean, so many, and Mr. Kuller is here, and the kind of institutions that we are creating at $1,500 per capita in 1.3 billion people, the poorest of the poor country, multi-ethnic society, I think it's just unbelievable. I think we'll create an economic miracle, and one of the biggest advantage in India from a global investor's perspective, there are very few economies where the economic growth could become the profitable growth for the entrepreneurs, which could be shared with the minority shareholders, and the investors in the markets could make that money with the kind of regulatory framework that we have put in place with the Reserve Bank and SEBI and the other regulators. So I think it will remain a stock picker's paradise. It will remain an investor's paradise for a very, very long time to come when the world is dealing with its own set of challenges. So as Sir Victor Hugo said, no power on earth can stop an idea whose time has come. I genuinely believe our time has come. Thank you so much.